Welcome to Shakti Pulse, where we bring insights from industry titans for the benefit of the founder community. And today we're joined by Cristina Morgan, who is a Shakti Titan. And Cristina has an incredible Wall Street career and was most recently the vice chairman of investment banking at JP Morgan. So Cristina, thank you for joining us.
Nice to be here.
And Cristina, I think one place would be great to start is just in terms of your own background and career. Would love to hear a little bit more about your trajectory in investment banking and what you focused on throughout your career.
Well, sure. My entire career was focused on technology in general and enterprise software in specific. I was very lucky when I joined H&Q in 1982 actually to be assigned or hired by the guy who covered what was then enterprise software. There were less than 12 public companies that existed that identified with that description. By the way, only half of them were actually software companies. The rest of them were really services companies pretending to be software companies. But again, I didn't choose it. It chose me. But as soon as I started covering the industry, I realized it was the greatest business in the world with the highest gross margins and truly just essentially fundamentally great business. You can certainly screw up even a great business, but it's harder to do that when you have a structurally profitable business in front of you. So I did that for all of the years that we existed as H&Q, and then when H&Q was acquired by Chase, and then Chase acquired JP Morgan, I continued in the same industry. My responsibilities broadened because since I ran investment banking at H&Q and I was in the senior management of the technology practice at JP Morgan, naturally other companies in other adjacent industries would come into my life. But when I was pursuing business, it was almost always the enterprise software world.
Great. And Cristina, I'm doing my background research. I read an interview that you did a few years ago. And one of the things that you said was, in terms of describing your job, you said, I finance entrepreneurs, the coolest people in the world. And I thought that was such an interesting way to think about investment banking. Can you tell us a little bit why do you think entrepreneurs are the coolest people in the world? And I guess as a bonus question, did you ever consider becoming an entrepreneur yourself?
Well, I can answer that backwards. Because of what I'm going to tell you about entrepreneurs, that's why I would never become an entrepreneur. I'm much better at helping them than I am in being them. But they're brave. They're incredibly brave. I mean, think about it. Most of them, and certainly the ones in the early days, mortgaged their house. They, quit their jobs. They put their families at risk because in the early days, software wasn't considered a financeable business. So there weren't venture capitalists beating down their doors with boatloads of money. They actually had to self-fund. So, they were people who wanted to change whatever problem set they were trying to solve for. And they were willing to quit their jobs at IBM or Bell Labs or whatever a regular paycheck they had coming in, because usually those companies said no to what they wanted to do. A lot of them in the early days went to the top managements of these big companies and said, gee, I think we should do this. And of course, those companies not wanting to cut off their installed base and not wanting to make a sacrifice in terms of the near term for the long term, said no. So these guys quit and started their own company. So I think they're brave. I think they're usually brilliant. They are usually overly educated. There's certainly the famous stories of the guys who drop out of school and start these companies. They're brilliant too, but a lot of mine are double E PhDs and really truly brilliant computer scientists who decide to pursue a path. So, listening to their stories and translating those stories back to an investment scenario is fascinating. So it's not like it was a hard thing to do. It was an incredibly interesting thing to do. But I didn't personally have the risk profile of wanting to quit my job and go solve a problem in the world because I'm not one of those double E PhDs. I don't have their brilliance. I don't have their insight. So I'm much better off giving them financing, putting gas in the car, getting them to the next stage than I am trying to be one of them.
Great. Yeah, I think I would have to agree with that for myself as well. And just switching a little bit too, in terms of the markets right now, Christina, when you and I had talked previously, I think this our general sentiment was that things look pretty grim right now. Can you tell us a
I
little?
know, and now we've had what, 5 days of straight up.
Yeah, we turned it around with our conversation, but can you tell us a little bit about kind of thoughts on the market right now? Where do things sit, and what really needs to happen for there to be signs of life?
Well, the signs of life you and I were talking about and are talking about now, you mean signs of life in the IPO market, because clearly signs of life in the generalized market have already appeared. I mean, all you need in the generalized market is for all of those colors to turn green when you switch on your list in the morning. And I keep switching on the list and everything just keeps going up. So I'm shaking my head and going, my goodness, we're kind of back. But that's, again, in the overall generalized market. I don't know that investors are still ready. They're ready to invest. And as you and I talked about the other day, the market did not need to go completely dead. There's simply too big of a gap between buyers and sellers. It's all a matter of valuation. So if a lot of wonderful companies chose not to go public during a particularly bleak time because the market was only willing to pay probably a third of what they are actually worth. And I'm not referring to the crazy pandemic numbers of what they thought they were worth. I'm talking about actual value of what they're worth. The market was looking for a bargain and looking to de-risk their own entry back into the markets by simply paying too little for these companies. Now, if you're desperate and you need money, it's just like selling a house. If you are in a desperate situation and you're moving and you need to sell, you are forced to take a below market value. If you're not desperate, and many of these companies are not even close to that description, you simply go back to work, put your head down, go sell software, and wait for a better time. And that's what they're doing. So hopefully, as the generalized market finds its feet, which it's clearly doing at the moment, we will see some of these companies dip their toe in the water. Believe me, they're ready to go. I mean, the investment banking business never stops. We never stop preparing companies to be ready to go to market when there's a window. So there are companies that are on the sidelines. All the documents are done. They haven't filed, or they filed silently, and they're just waiting for better days. And how can you blame them?
Yeah, one thing I was wondering, Christina, is when you think about your investment banking colleagues right now, I mean, they're definitely not just kind of sitting at home doing nothing. Like, what kind of companies do you think your colleagues are talking to right now? I mean, they must be out there talking to CEOs. Who are they talking to about bringing out to the public markets when things open up a little bit more?
The same companies you would talk to in any market. I mean, they're in any given sector of the software business, in any given sector of any business. There are a few companies, pretty much everybody knows about them, who are leading the charge in their area. Those companies are pursued by investment bankers who follow these industries year in, year out, cycle in, cycle out. You just keep talking to them. We are a transaction-based model, so we only get paid when a transaction happens. One would argue we are overpaid when that transaction happens, but again, we drill a lot of dry holes. I mean, the folks who, in my practice, who cover technology, haven't done a deal. Well, they've done a couple of deals. There was Klaviyo, there was Instacart, there was, there were a couple of them, but there was nowhere near enough to keep a practice alive. But the investment banking business has always been like that, and we are a peaks and valleys business, and one can argue we are overpaid in the good times and horribly underpaid in the bad times, but that is the life that we've chosen. So it's lawyers are different. They get to get paid by the hour, no matter what. So they're talking to companies that are large, growing, profitable, and are in a space in the whiteboard that either needs disruption or is frankly a new space on the whiteboard.
Can you tell us a story about an IPO that came after the dot-com crash, or an IPO, after the financial crisis crash? And how did the markets open after those times? Obviously, history doesn't repeat itself, but what's an example of a company that came out of either of those crashes, and what did it take for that to go public?
Well, a good story is the SolarWinds story, which is, we won the business. I believe it was the end of 2007. And then, of course, the financial meltdown of the world happened in 2008. None of us knew how long that was going to last. But in that case, we just kept drafting and kept going. And we did file silently sometime in 2008. And literally just sat on the sidelines waiting for a better time. It turned out we sat on the sidelines for all of 2008 and part of 2009. I think it was either April of May or May of 2009 when we finally did go public. It was the first software company and the first technology company to go public out of the financial crisis. And it was very successful, but meaning that the stock went up from where we sold it. But let's remember that we took it public for probably a third of what it would have gotten had not we been in a completely buyer's market. So and the only reason that happened was that it had an excellent board. It had a clear-eyed bunch of people looking at the situation. The CEO was not the founder. He was an operating and probably the best operating executive I've met. And he had a very clear-eyed view, which was that we can be unhappy about the valuation, or we can realize that we are selling 10% of the company at a price that we don't like, but it puts the puck on the ice. It gets the path to liquidity going. If it goes up, we all have the choice not to sell at the IPO, which of course nobody did. And we will sell in better times, but we will already have a liquid market in which to sell our securities. So they had been private for a long time, and they just decided that was the path for them. Naturally, the very fact of that deal working, about a month later, we took LogMeIn public, which was a much tighter situation because we were going to follow SolarWinds, and that one went well too. And then with 2 data points of technology deals working, the institutional buyers are not paid to sit on the sidelines in cash. They are paid to buy something and sell something. They are paid to do something. It's called active management for a reason. So once there was some kind of data point out there that deals were working, deals started to flow. And that's what we need now. We need some deals to work, which, quite unfortunately, most people are not original thinkers. Most people follow patterns. Most people look at data, look at patterns, and decide that there's some kind of meaning in those numbers. Now, that's sometimes true. It's not always true. But that's what they're looking for, is relevant data points to show them that it's time to go back in.
I mean, the stats around the number of unicorns that are currently sitting on the sidelines, close to 1,000, is extreme. And so I think, you kind of answered to your point of what it takes for one of those to get out there in IPO is someone has to be comfortable with getting out there at a valuation which is well below where they raised, and open it up for others.
Yeah, well, the whole, celebration of the unicorn concept and the designation of the unicorn and the attaching value to raising money at crazy ass prices is a false construct. I mean, anybody who's a real business person who is trying to build a business looks at those kinds of stories and shakes their head, even if they are one of them. Even the guys who run the companies that were massively overvalued, a lot of those shake their heads at. They didn't see that they had a choice. If someone's offering you money at an absurd valuation, it's pretty hard not to take it. It doesn't mean you endorse the valuation. All you can endorse is your own business and what you believe that business is willing to accomplish. What someone's willing to pay for it, that's the other side's job. So it's, it's just interesting. I do have companies that are ready to go, and they never bought into the craziness. They never took money during the pandemic because they didn't need it. And there's nothing like, my favorite companies of the world are companies that don't need to raise money. I mean, everybody loves to give money to people who don't need money. They actually don't want to give money to people who actually need money, at least in hard times. In bull markets, all the rules don't apply. A bunch of amateurs get into the business. A bunch of people who have no business evaluating these situations get in charge of evaluating them, assign crazy numbers, and bad things happen. But that's the nature of bull markets.
Yeah, and it kind of goes back to kind of the overall discussion of capital efficiency. And in terms of, do you think the pendulum will swing back to, companies that are raising a little bit in the private market and then go raise more in the public market, which is really what it was 30 years ago. And somehow that changed along the way, where companies raised a lot of money in the private markets, they stay there for a really long time, and then the public market is really just for a liquidity event. Versus a fundraising event. It feels like the pendulum is swinging back the other way.
Yeah, but I personally never trust pendulums, and I never trust generalities. I go into every single company thinking it's a different journey, and it's a custom business. That's why investment banking has never been completely automated. A lot of the tools we use are automated, but the actual personal relationship between an entrepreneur and their primary or lead investment bankers, or two or three of those people, you can't automate that. That is a personal relationship, and it's advice. And if it isn't customized to your particular situation, I'm not sure it's worth a lot. We come in with 40-page books of charts. I never took 40-page books because I hate boring people, but I took 2 charts. But everybody goes in with lots of charts about what is and what the generalized trends are. And I don't disagree that it's not interesting, and I don't disagree that it can be educational, but it is not dispositive about what any one company should do. These people need to run their companies and finance their companies in a way that makes sense for them, no matter what the trends are. But I will, at the two ends of the spectrum, everybody's throwing money at you and nobody wants to invest in anything, which we've experienced in the last few years, it's pretty hard. And that's why only the strong will survive. Only the structurally constructive, profitable companies will survive, because those are the companies who do not need outside capital. If you need outside capital, you are at the whims of the markets.
Yeah. And that's what we've been advising and messaging to our companies as well, which is get to profitability as quickly as possible and don't be reliant on outside capital at this stage. So switching gears a little bit, Cristina, you mentioned earlier in terms of one of your stories that there was a board, a successful board. And what is the role of a board of a company from your experience as a banker? And what are some examples of things you've seen board members do really well, especially venture capital board members? And are there any things you've seen board members do that are not helpful to a company or to a founder?
Well, it's not going to surprise you to hear that the answer is pretty much like any other part of your life, which is that people that are helpful are great, and people that are not very helpful are not great. And the board relationship, again, everybody is chosen to be on a board to serve a particular kind of role. It's a very curated process. CEOs are looking to their board to provide not all the same things. I mean, each board member is probably a little different, and given their background, is going to be more useful for some things than others. Having said that, what board members bring to their boards is their judgment, their experience, and their ability to communicate that in an effective way with their fellow board members, and most primarily with the management team. My favorite kind of board members are former operating executives. So I'm not my favorite kind of board member. I've seen a lot of movies, but I am an agent, not a principal. I have never run a company. And therefore, I can't really say this happened to me 2 or 3 times and here's what I did about it. I can say I've seen this happen dozens of times and here's what happened in those cases. But again, it's like everything else that we're talking about. Every problem has got a very individual nature to it. So to say that just because this worked out for that guy does not mean it's going to work out for you. So, but having said that, it is an art to be an effective board member. I do believe operating executives make excellent board members because they really can say, to talk about being useful, they can say, I was in your shoes. This is what my thought process was. It doesn't mean it needs to be yours, but at least you can learn from my experience. So when, not to pick on, people that have this profile, but when someone goes to any one of the fancy schools and gets out, goes right into venture capital, has never had a job, and is sitting on the board and telling the CEO what they would do in his shoes, well, I'm not sure that, that experience is, I'm sure it's not as useful as an operating executive. But like me, they can say, well, here's the data we have around this problem. And thus they can add value that way. So everybody can figure out their way to add value. But at the end of the day, you have to add value. And if you don't, you get a reputation for being pretty useless. And it's as big as our industry has gotten and as big as the Silicon Valley and its extended markets all over the world has gotten from the time I joined it in all those years ago. Out here, it's still kind of a village. It's a lot of people know each other. And there's an awful lot of ways to check people out within our networks. So yeah, behavior matters, communication matters, ethics matter, all of that stuff matters.
Great. Yeah, so helpful. A lot of our founders are right at that stage of starting to build their boards. So, and Cristina, one thing I wanted to ask you about was your take on women in leadership. At Shakti, we have many, many female CEOs, and you've been recognized as Fortune's America's 50 Most Powerful Women, among other lists. What advice would you give to young women who are first-time founders or just getting into business?
It's funny. I just saw an interview with Helen Mirren yesterday, and she was asked what advice she would give young women getting in the movie business and the entertainment business. And she said, show up on time, know your lines, and don't be a jerk. And I thought, well, gee, that's kind of what I tell everybody when they get in the investment banking business. Work hard, know what you're doing, and don't be a jerk. And I say that to both young men and young women. It's a team sport. It's a tough industry. It has got all sorts of stressors that are going to happen all the time. You need to be part of the solution, not part of the problem. You need to throw water on the fire, not gasoline. Good grief, try not to be a jerk. And I think there are less women that are jerks than guys in general, but that too is a generalization and not really particularly fair. But I really don't think, I personally never had a whole lot of problem making my way through the storm because I was more focused on swimming through the storm. I was more focused on getting us through it than I was in who it was that was going to help me and what gender that person happened to be. I was like, however we're going to get from the point we are to the end zone, I'm going with whoever can catch the ball. I don't care what they look like or what they sound like or anything else. I just need them to catch the ball. So I don't have any great solutions for everybody. I know a lot of successful women. One of the things I love about Shakti is that, yes, you guys do have quite a few women CEOs. But another thing I like about it is that Keval could pass a lie detector test when he says he didn't actually go out and seek that out, that he went to look for good investments. And now he's going to argue, and I would argue that he was open-minded, relative to gender, much more probably than other people. But it wasn't something he decided to do as a goal of the firm. He tells me anyway, and I just think that's great, because I think that if you keep your eyes open, naturally good ideas come from everywhere, and it's ridiculous to think that it is determined by gender or by nationality or by anything else. I mean, so many of my founders are foreign born. I think probably if I look back over the couple hundred companies that I've taken public, I'll bet you it's more than 50% that are foreign born. So, and it wasn't like I was looking to finance Israelis or Chinese or Russians, or I wasn't looking to finance people of different international backgrounds. Those are just the people that were running the companies that I was pursuing, because they were smart and educated and had all those profile things that we talked about. So gender isn't any more deterministic of outcome than any other thing I can pick out. So I think we all have to stay pretty open to everything.
Yeah, so well said. And Cristina, I guess lastly, just we're kind of coming to the end of the year here, and was curious if there's anything looking to 2024 that that you're excited about or hopeful about for the future, or any industry trends that you're excited about. Kind of an open-ended question, but if there's anything that you're looking to for 2024 that that might be exciting.
Well, I do think that we've been in a dark place for so long. And I personally believe, I mean, I've been doing this for a long time, and we always come out of these bear markets. I mean, we go through these situations for different reasons, whether it's the dot-com crash, or it's the financial crisis of 08, 09, or it's this reaction to the insanity of the pandemic years. We've now been in it for a good long time. Usually those things, when we first plunged into it, everybody kept calling me and saying, how long is this going to take? And I said, well, that's the problem. We just got in it. So these things take a while to work their way through. So the good news is we have been working our way through here now for a couple of years. So usually these things don't last a couple of years. Let's remember that we were only out of business after the financial crisis for 5 quarters. So relatively speaking, we have been in the dark here for even longer than that. And frankly, that was really scary, because people were really concerned that the entire financial system of the world was going to crater. So that's a little different from thinking that we overpaid for a bunch of companies. I mean, so it's so I think that the good news, and I'm usually pretty much the least optimistic person around, but I'm actually pretty optimistic, because I think we've been down for a long time. I think that the people that survived this downturn are stronger for it. Therefore, those companies have indeed, talk about the pendulum swinging, they have realized that the growth at all costs model is not what people want to hear. It's either you can be unprofitable in the short term, but you got to have a path to profitability, or be profitable now. So stronger, better companies will go public at lower valuations than they would have gone public 2 years ago or 3 years ago. And that makes, at some point, for a meeting of the minds between buyers and sellers. As soon as you see those first couple of deals work, you will then see other people, the market will open up for other folks. And hopefully everybody will keep their head on straight and keep insisting on paying reasonable numbers for reasonable forecasts. And at that point, you've got a workable market. And so I do think I do think 2024 is the year we will find our way back to a workable market. And it will be led by some of the best companies. So it's actually those boards and those investors will not be particularly happy with the first 2 deals valuation, but they, like other boards and management teams, will realize that the percentage of the company that they're selling is so small that in the total return that they'll get for the company, it's not going to matter much. So I do think we're headed for better times, and it may not be straight away because it never is, but by spring, I bet you that we're back in business.
All right. We'll leave it there on that optimistic note. Thank you so much, Cristina, for joining us for another episode of Shakti Pulse.
Yes, indeed. See you soon.